Nothing is wrong with the euro itself. It is rather the policies of the governments of the Eurozone and the European Central Bank that are wrong. This is the argument put forward by my colleague Martin Sandbu in his provocative new book, Europe's Orphan, The Future of the Euro and the Politics of Debt. So Martin, congratulations on the book and on your bold and provocative position. So just explain, what exactly are you arguing?
Well, it's in the title. I bet Europe's orphan is the euro, which I think has been disowned by its kin, metaphorically speaking. There's a standard story we're being told about the Eurozone economy, which blames the euro for all its woes. It has a past and a present and a future, this story, and in the book I try to explain why each part is wrong in my view. Looking back, we're told that the euro caused the crisis, or at least contributed to the debt that was at the heart of the crisis. During the crisis, we were told there is no alternative because of the euro to these bailout packages that sent huge transfers from Germany and other countries to the debtor countries in exchange for harsh austerity, overly tight monetary policy and structural reforms. And going forward, we're told because the euro is broken, the only way to reinvigorate Europe's economy is to complete the monetary union with a fiscal union, with a political union, basically all the things that the citizens of Europe were promised would not happen. I think that's dangerous, even if it's right, but I also think that it's wrong, and that makes it not just dangerous, but reckless.
So you better explain what the alternatives are. Let's not go back in this limited time to the history, because we can get into so much detail, but look at what they did in the context of the crisis and what they should have done. Well, so you've described the wrong policies. What are the right policies?
So I think the original sin in the crisis was to pretend that debts that could not be paid back, or at least not on time, had to be paid back. So there was an absolute unwillingness at the outset to consider restructuring either of Greece's sovereign debt and maybe more importantly of the private debts in Ireland, in Spain and other countries. Now, people were afraid, of course. I call this Lehman syndrome in the book. People thought that this would cause all kinds of disasters. In fact, historical experience, economic evidence and research and common sense suggests that an approach of deep, quick restructuring at the outset would have allowed the economies to recover much faster, whereas the true disaster came from pretending that this debt could be serviced and tried to refinance, making the private debt public debt, and in the process impose policies that actually restrained growth. The key difference is this: you have a stock of outstanding debt and you have a flow of deficits. The right policy would have been to cut the stock, but be tolerant about the flow, because the flow is where daily economic activity happens. What they did instead was to protect the stock, protect all these debts, pretend they could be repaid, but squeeze the flow. And in doing so, they squeezed economic growth, not just once, but twice.
Well, let's just think about that story. I have a lot of sympathy on the restructuring of the private bank debt. But let's just think what would have happened. So right at the beginning of the crisis, they had already 3 countries in considerable difficulty, not just Greece. So they start restructuring the bank debt and the public debt of these countries, particularly of Greece, but possibly also of Portugal. And then there was Spain and Italy in the wings, as we know. So you make clear that there's a real risk that debt will be restructured. Nobody knows who and when. Surely you more or less guarantee a major crisis in the sovereign debt markets, and given the dependence of the banks on the sovereigns, that was a reality whether you like it or not, then in the bank market. So the crisis would have been much worse, wouldn't it?
Well, one thing you could look at is a historical experience with sovereign defaults. There have been 2 big waves, the 30s and the 80s, 90s. And the historical experience shows that actually it's when you definitively restructure that things pick up and get better. Because the point is this: that uncertainty happened anyway. And because they tried to pursue a policy that was not credible, they reinforced and made the uncertainty worse. People just kept being afraid. And that's arguably, in addition to the policy conditions that came with these bailouts, austerity and so on, that's what put the Eurozone back into a second recession, a self-inflicted recession, in my view. So this is partly, it's not true, I don't think, that a restructuring would have been quite so bad as you say. Also, we have to admit that the lack of restructuring was worse than people thought. And in any case, even without the euro, you would have had unpayable debts and you would have needed restructurings anyway.
But just
So
one-
even if that is true, don't blame the euro.
One last question. This is, of course, I'd love to go into further. But basically what you're saying is, think about it right at the beginning, that early period. Are you saying that to clean it all up, they should have restructured the debt of Italy right at once and just told the Italian government, which was desperate to avoid this, that they should just gone ahead and defaulted to their own citizens?
Well, in the Italian case especially, it's quite interesting because, of course, they weren't really having big deficits and no primary deficit. They didn't actually need ongoing financing for their deficit. It was a legacy debt issue.
Which got worse.
In the worst case scenario, of course, there would have had to be, I think in the Italian case, a standstill, a moratorium, not an outright default. I'm not saying it would have been pretty, but I think that for all of Europe, it would have been not as bad as what actually happened.
Well, thank you very much, Martin. This is just a small taster of this fascinating debate, and there's no doubt this is a very provocative and very interesting book. And I would encourage anybody interested in the Eurozone crisis, which should be almost anybody interested in what's going on in the world economy, to look at it.